How Japanese housewives became the most feared traders on Wall Street. In the early 2000s, something strange started happening in global currency markets that confused and terrified the world's most sophisticated traders. Hedge fund managers with PhDs in mathematics, investment banks with supercomputers and armies of analysts. They were all getting destroyed by an invisible force they couldn't understand or predict. Billions of dollars were moving in ways that made no sense, according to traditional models. Currency values were swinging wildly. And when Wall Street finally figured out what was happening, when they finally identified the force that was moving trillions of dollars and disrupting global markets, the answer was so unexpected, so improbable that it became legendary in trading circles. The force wasn't a hedge fund, wasn't a central bank, wasn't some secret cartel of institutional investors. It was Japanese housewives, millions of ordinary Japanese women sitting at their kitchen tables with laptops, managing their family savings and making currency trades that collectively moved more money than most countries' GDP. They had no formal training in finance, no fancy algorithms, no insider information, just common sense, patience, and an understanding of one simple concept that Wall Street had somehow forgotten: the carry trade. These women, collectively nicknamed Mrs. Watanabe by the financial press, became so influential that currency traders worldwide would watch Japanese retail trading data the way others watched Federal Reserve announcements. Because when Mrs. Watanabe moved, markets moved. And when Mrs. Watanabe panicked, global financial crises followed. But here's what makes this story absolutely fascinating. These weren't professional traders getting lucky. These were housewives who had been entrusted with managing household finances in a culture where women traditionally control family budgets. And they discovered that in a world of near-zero interest rates in Japan, they could borrow yen essentially for free, convert it to higher-yielding currencies like the Australian dollar or New Zealand dollar, earn the interest rate differential, and make more money than their husbands were earning at their salaries. And they did this so successfully, at such scale, that they accumulated trillions of dollars in positions, became the largest participants in certain currency markets, and when the 2008 financial crisis hit and they all tried to exit their trades at once, they triggered currency swings so violent that central banks had to intervene. And even today, over a decade later, professional traders still watch for signs of Mrs. Watanabe's activity, because when millions of housewives decide to move their money, nothing can stop them. Not banks, not governments, not all the PhDs on Wall Street. Let me take you back to 1992 Japan to understand how this happened, because Mrs. Watanabe wasn't created in a vacuum. She was the product of specific economic and cultural circumstances that turned ordinary housewives into global currency speculators. In 1989, Japan's economic bubble burst. The stock market crashed, real estate prices collapsed, and Japan entered what would become known as the Lost Decades, a period of economic stagnation that continues in some ways to this day. GDP growth stagnated, deflation became chronic, and most relevantly for our story, interest rates collapsed to near zero and stayed there. The Bank of Japan cut rates trying to stimulate the economy, and by the late 1992, you could borrow yen at interest rates close to zero, literally 0.1% or 0.5%. And if you had savings in a Japanese bank, you were earning basically nothing. Your money was just sitting there, losing value in real terms, even without inflation, because the opportunity cost was enormous. And this created a massive problem for Japanese households. Because in Japanese culture, it's traditionally the wife who manages household finances. The husband works and brings home a salary, but the wife controls the budget, pays the bills, manages savings, makes investment decisions. And these women, these housewives, who had been entrusted with their family's financial security, were watching their savings earn nothing, while prices for imported goods were rising, and the cost of sending kids to university was increasing, and they needed to find a way to make their money grow. At the same time, financial deregulation in the 1992 and early 2000s had made it much easier for retail investors in Japan to access foreign exchange markets. Previously, Forex trading had been restricted, dominated by institutions, but new online platforms emerged that allowed anyone with a computer and an internet connection to trade currencies. And these platforms marketed aggressively to Japanese retail investors, offering leverage, offering easy-to-use interfaces in Japanese, offering educational materials about Forex trading, and most importantly, they highlighted the opportunity that was staring every Japanese saver in the face: the carry trade. The carry trade is conceptually very simple. You borrow money in a currency with low interest rates, convert it to a currency with high interest rates, and earn the difference. So if you can borrow yen at 0.5% and buy Australian dollars that are yielding 6%, you make 5.5% annually just by holding the position. And with leverage, which the Forex platforms offered generously, you could multiply those returns, put up 1 million yen, borrow 10 million yen more using leverage, convert all 11 million yen to Australian dollars, and if the exchange rate stays stable, you're earning 5.5% on 11 million yen, which is 605,000 yen annually on your 1 million yen investment, a 60% return. And this was essentially risk-free as long as two things remained true: interest rate differentials stayed large, and exchange rates remained stable. And in the early 2000s, both of those conditions held. The Bank of Japan kept rates at zero, while Australia, New Zealand, and other commodity-producing countries maintained much higher rates, and currency volatility was relatively low, so the carry trade was printing money. And Japanese housewives, who had time during the day while their husbands were at work and their kids were at school, who were comfortable with computers and detail-oriented record-keeping, who were motivated to grow their family savings, they started opening Forex trading accounts and doing carry trades, at first in small amounts, cautiously. But as they made money, as they talked to friends and relatives who were also making money, as the media started reporting on ordinary housewives earning more from currency trading than their husbands earned from their salaries, the trend exploded. By the mid-2000s, millions of Japanese households were engaged in carry trading, and the scale was staggering. Estimates suggest that Japanese retail Forex traders, the vast majority of whom were housewives, controlled positions worth trillions of dollars. They were the largest participants in currency pairs like AUD, JPY, and NZD. JPY, larger than any bank, larger than any hedge fund, a distributed network of millions of individual traders making similar decisions based on similar logic. And because they were all doing the same trade, borrowing yen and buying high-yielding currencies, they collectively put enormous pressure on exchange rates. The yen weakened significantly during this period, which was actually good for Japan's export-oriented economy. And the high-yielding currencies strengthened, which was good for those countries' exports and housing markets. And Mrs. Watanabe was making money. Lots of money. There are stories of housewives who turned modest savings into fortunes. Women who made more in a year of Forex trading than their husbands made in a decade of salaried work. And this wasn't gambling or speculation in the traditional sense. They weren't day trading. They weren't trying to predict short-term movements. They were just collecting interest rate differentials, holding positions for months or years, and the money kept rolling in. And Wall Street noticed. Currency traders at major banks started referring to Mrs. Watanabe as a shorthand for Japanese retail flow. They would analyze Japanese retail trading data, trying to predict when Mrs. Watanabe would enter or exit positions, because her collective actions moved markets. If Mrs. Watanabe was buying Australian dollars, the AUD would strengthen. If she was selling, it would weaken. And because there were millions of her, because her trades were driven by fundamentals like interest rate differentials, rather than short-term speculation, she was a persistent force, not easily shaken out by volatility or scared by market moves. But there was a problem lurking in the carry trade that Mrs. Watanabe didn't fully appreciate or chose not to think about. The risk that exchange rates might not remain stable, that the currencies she was buying might fall in value against the yen, wiping out years of interest earnings in a matter of days or weeks. And this risk, which is called exchange rate risk or currency risk, is the hidden danger in every carry trade. You can earn 5% annually in interest differentials, but if the currency you're holding falls 10% against your home currency, you've lost money overall. And the higher the leverage you're using, the worse the losses can be. If you're leveraged 10 to 1 and the currency moves 10% against you, you've lost your entire capital. And in volatile market conditions, moves of 10% or more can happen very quickly. And this is exactly what happened in 2008. When the global financial crisis hit, when Lehman Brothers collapsed, and credit markets seized up, and risk appetite disappeared overnight, investors around the world started unwinding risky positions, selling assets, moving to safety, and the carry trade, which had been the most popular trade in the world, suddenly became toxic. Nobody wanted to hold risky, high-yielding currencies anymore. Everyone wanted to hold safe haven currencies like the yen and the dollar. And Mrs. Watanabe, who had been sitting on profitable carry trades for years, suddenly faced a nightmare scenario. The Australian dollar and New Zealand dollar were collapsing against the yen, falling 20%, 30%, 40% in a matter of weeks. And because many housewives were using leverage, their positions were being automatically closed out by their brokers when losses exceeded their margin. And this forced selling created a feedback loop as Mrs. Watanabe sold Australian dollars to close positions. The AUD fell further, triggering more forced liquidations, triggering more selling, and the yen surged. And the speed and scale of these moves was unprecedented. The Australian dollar fell from around 108 yen to around 55 yen in just a few months, a 50% collapse. And every Mrs. Watanabe who was leveraged in that trade lost everything. Their entire savings, years of gains, wiped out in weeks. The Japanese financial press was full of stories of devastated families, women who had lost millions of yen, who had been trying to improve their family's financial situation and instead had destroyed it, who had to tell their husbands that the family savings were gone. And in a culture where shame and honor mattered deeply, this was traumatic. Some women didn't tell their families, kept hoping they could trade their way back to even, which of course usually made things worse, borrowed more money, took on more leverage, and lost that too. The currency swings misses. Watanabe caused in 2008 were so severe that they had real economic consequences. The yen's surge hurt Japanese exporters, making their products more expensive overseas. The Australian dollar's collapse hurt Australia's economy, and central banks had to intervene. The Bank of Japan actually tried to weaken the yen by intervening in currency markets, essentially fighting against misses. Watanabe's unwinding of carry trades and the whole situation revealed something important about global finance. Retail traders, when they're all doing the same thing at sufficient scale, can be as systemically important as banks or hedge funds. Misses. Watanabe wasn't too big to fail, but she was too big to ignore. Her collective actions moved trillions of dollars and could destabilize markets and economies. And nobody had really thought about this risk before, because retail traders had never had this kind of access and leverage before, had never been able to accumulate such enormous positions. After the 2008 crisis, you might think Mrs. Watanabe would have learned her lesson, would have abandoned currency trading and gone back to conservative savings. But that's not what happened. After licking her wounds, and in some cases losing substantial amounts of money, Mrs. Watanabe came back. Interest rates in Japan remained at zero. Savings accounts still paid nothing. And the appeal of earning interest differentials through carry trades remained strong. So by 2010, 2011, Mrs. Watanabe was back in the markets, more cautious perhaps, using less leverage, more aware of exchange rate risk, but still pursuing the same basic strategy: borrow yen cheaply, buy high-yielding currencies, collect the differential. And through the 2010 seconds, this pattern repeated. Mrs. Watanabe would build up large carry trade positions during calm markets. These positions would grow over months and years as she collected interest. And then, during periods of market stress, during risk-off episodes, she would be forced to unwind, selling her high-yielding currencies, buying back yen, contributing to currency volatility, and then once markets calmed down, she would start building positions again. It became a predictable cycle that professional traders learned to anticipate and trade around.
But Mrs. Watanabe evolved. She wasn't just doing simple carry trades anymore. She was becoming more sophisticated, diversifying into different currency pairs, using options to hedge exchange rate risk, following global economic news more closely. And most interestingly, she started investing in other countries' stock markets, particularly the U.S. stock market. Because with yen interest rates at zero and the carry trade having proven risky, looking for returns in foreign equities made sense. And just as she had become a force in currency markets, Mrs. Watanabe started becoming a significant force in equity markets. Japanese retail investors buying U.S. stocks, buying emerging market funds, buying whatever offered returns higher than what they could get at home. And again, because there were millions of them making similar decisions, their collective impact was significant. The cultural aspect of Mrs. Watanabe is fascinating and important to understand. In Japan, wives managing household finances isn't just common, it's expected. Husbands typically turn over their entire salary to their wives, who give them an allowance for daily expenses, and the wife is responsible for everything else: paying bills, managing savings, planning for children's education, preparing for retirement. And this means Japanese women, despite often not working outside the home or working only part-time, have real financial power and responsibility. They're making investment decisions that determine their family's financial future. And when Forex trading became accessible and profitable, it was natural that women would be the ones exploring it. They had the time, they had the motivation, and they had control of the capital. There's also a social aspect. Housewives would share trading tips and strategies with each other, discuss currency trends at social gatherings, form informal investment clubs, and this word-of-mouth sharing contributed to the explosive growth of retail Forex trading. If your neighbor was making money on the carry trade, you wanted to try it too? And the information spread through social networks in a way that was invisible to traditional market analysis. Wall Street traders couldn't see misses. Watanabe organizing couldn't predict when a wave of new retail traders would enter the market because it was happening through conversations at school pickup lines and neighborhood gatherings, not through Bloomberg terminals and trading floors. And the Japanese financial media amplified this, with magazines and television shows teaching housewives about Forex trading, profiling successful retail traders, making it seem not just acceptable but aspirational. The message was that smart, modern women should be actively managing investments, not just letting savings sit idle. And this cultural shift, from conservative saving to active trading, happened remarkably quickly, driven partly by economic necessity given zero interest rates, but also by changing attitudes about women and money and financial independence. The leverage that Japanese Forex brokers offered was, in retrospect, insane. Ratios of 1:0:0 to 1 or even 4:0:0 to 1 were common, meaning you could control $400,000 worth of currency with just $1,000 of your own money. And while leverage amplifies gains, it also amplifies losses, and a small adverse move in exchange rates could wipe out your entire account. But the brokers marketed leverage as a way to maximize returns. And many housewives, not fully understanding the risks, used maximum leverage, thinking that more leverage meant more profit, not realizing it also meant that they could lose everything in a sudden market move. After 2008, Japanese regulators did eventually step in, limiting leverage to 2.5 to 1 for retail Forex traders, which is still high by international standards but much lower than what had been available, and requiring brokers to provide better risk disclosures. But the damage had been done. Millions of households had lost significant amounts of money, and while some misses, Watanabe's became more sophisticated and continued trading successfully. Others left the markets entirely, scarred by their losses. The professional trading community's reaction to Mrs. Watanabe evolved over time. Initially, there was condescension. These were just housewives, amateurs. They didn't understand markets. They would eventually get wiped out. But as years passed and Mrs. Watanabe kept coming back, kept accumulating positions, kept moving markets, the condescension turned to grudging respect and then to careful attention. Because love her or hate her, dismiss her or fear her, Mrs. Watanabe was a force that couldn't be ignored. She had staying power, she had capital, and she had numbers. And any trader who ignored Mrs. Watanabe did so at their peril. There's a famous story, possibly apocryphal, but repeated in trading circles, of a hedge fund manager who was short the Australian dollar, expecting it to fall, and his position was getting crushed as the AUD kept rising, and he finally asked his analysts what was going on. Why was the AUD so strong despite weak Australian economic data? And they told him, Mrs. Watanabe is buying? And he said, who the hell is Mrs. Watanabe? And when they explained, he couldn't believe it. Couldn't believe that his multi-billion-dollar hedge fund was losing money because millions of Japanese housewives were doing carry trades. But that was the reality, Mrs. Watanabe had more capital and more conviction than he did. and she won that particular battle. The lessons from Mrs. Watanabe's story are nuanced and not what you might expect. The simplistic lesson would be, don't trade currencies, or leverage is dangerous, or amateurs shouldn't compete with professionals. But those aren't the real lessons. Because Mrs. Watanabe wasn't entirely unsuccessful, many housewives made good money from carry trades during calm periods, and the strategy itself, borrowing in low-interest currencies to invest in high-interest currencies, is sound in principle. It's a strategy that professional traders and institutions use all the time. The problems came from excessive leverage, from not understanding or preparing for exchange rate risk, from getting caught in forced liquidations during market panics, and from the herd behavior where millions of people were doing the exact same trade. So when it went wrong for everyone simultaneously. The real lesson is about risk management and understanding what you're doing, Mrs. Watanabe's success during good times came from having a simple, logical strategy and sticking to it patiently. Her failures during bad times came from using too much leverage and not having exit plans. If you're going to do a carry trade, you need to accept that exchange rates can move against you. You need to use moderate leverage or no leverage. You need to be prepared to hold through volatility or have clear stop losses. And you need to understand that when everyone is doing the same trade, the exit can become crowded and painful. Another lesson is about information asymmetry. Mrs. Watanabe didn't have less information than Wall Street. In many ways, she had better information, because she understood Japanese culture and society and economic reality in a way that foreign traders never could. She knew that zero interest rates were going to persist. She knew that Japanese savers were desperate for returns. She knew that millions of housewives were facing the same problem she was. And this local knowledge gave her an edge. Professional traders looking at macroeconomic data and central bank statements missed the social phenomenon happening at the retail level, missed the fact that millions of households were becoming active currency traders, and by the time they noticed, Mrs. Watanabe was already a dominant force in the market. There's also a lesson about democratization of finance. The Mrs. Watanabe phenomenon was only possible because of technology and deregulation that gave retail investors access to markets that had previously been restricted to professionals. And this democratization has good aspects. It lets ordinary people access investment opportunities and potentially improve their financial situations. But it also has dangerous aspects, because retail investors often don't have the knowledge or risk management sophistication to handle leverage in volatile markets. And when millions of retail investors are doing the same thing, it can create instability. This is a pattern we've seen repeatedly, from Mrs. Watanabe in currency markets to retail traders in meme stocks to crypto speculation. When retail gets access to leverage and complex instruments, some people make money, many people lose money, and markets become more volatile and unpredictable. Today, Mrs. Watanabe is still active, but less dominant than she was in the 2000s, partly because regulators limited leverage, partly because some housewives left the markets after being burned, and partly because other investment opportunities have emerged. But Japanese retail investors remain significant participants in global markets, particularly in U.S. equities and bonds, and traders still pay attention to Japanese retail flow data, still watch for signs of Mrs. Watanabe's activity, because she has a history of moving markets. And while she might not be the force she once was, she hasn't disappeared. She's just diversified, evolved, become more sophisticated, and she's waiting for the next opportunity. the next interest rate differential or market inefficiency that she can exploit. Because at the end of the day, Mrs. Watanabe is just trying to take care of her family, trying to make her savings grow in an environment where traditional saving doesn't work. And if that means becoming one of the most feared forces in global currency markets, well, so be it. The Mrs. Watanabe story challenges a lot of assumptions about who matters in financial markets, about who has power and influence. The narrative is usually about hedge funds and investment banks and sovereign wealth funds, about men in suits making billion-dollar decisions in Manhattan and London. But Mrs. Watanabe, sitting at her kitchen table in Tokyo or Osaka, with no formal training and no institutional backing, became just as important, more important even, because there were millions of her, and her decisions, collectively, moved more money than most institutions, and she did it by understanding one simple thing. In a world of zero interest rates, you need to take risk to generate returns. And the carry trade was a way to take calculated risk that made sense given Japan's economic reality. Whether she succeeded or failed on any particular trade, whether she made money or lost money, she was trying, she was active, she was engaging with global markets and taking control of her family's financial destiny, and there's something admirable about that. Even when the outcomes were painful, even when leverage and volatility destroyed savings, because the alternative was doing nothing, watching savings earn zero while prices rose and the family's financial security eroded. So the next time you hear about retail traders moving markets, whether it's GameStop or Bitcoin or whatever the next phenomenon is, remember Mrs. Watanabe. Remember that retail, when organized or just moving in the same direction for the same reasons, can be more powerful than institutions. Remember that the smartest trade isn't always the most complicated. Sometimes it's just borrowing cheap and lending expensive. Remember that leverage is a double-edged sword that can multiply gains, but can also wipe you out. And remember that the most unexpected players, housewives with laptops, can become the most feared forces in global finance, not through sophistication or insider knowledge, but through simple logic, collective action, and the desperate need to make money grow in an economy where traditional saving no longer works. Mrs. Watanabe taught Wall Street humility, taught them that markets aren't just for professionals, that sometimes the amateur with common sense beats the expert with fancy models. And even though she suffered through painful losses during market crashes, she came back. She adapted, she learned, and she's still out there, still managing her family's finances, still looking for opportunities, still moving markets in ways that confuse and terrify the professionals who thought they understood how everything worked. And that's a legacy that goes far beyond any particular trade or profit or loss. That's a story about financial empowerment and democratization, and the unexpected ways that economic forces shape our world.